This session provides general information only and does not take into account your objectives, financial situation, or needs. It is not personal advice. Views expressed may not reflect Net Wealth's, and Net Wealth may receive fees for products discussed. Please seek professional advice before acting.
You have these family office principals. Every generation, eventually, the principal changes.
The operations role is much more tactical as opposed to somebody who can handle and ensure really the execution of the firm's growth strategy.
And literally, I've gone deep into some pretty technical subjects, and hopefully in a way that enables people to not only grasp them, but can say, how can I apply this for my individual situation? We just want to help people give with warm hands and equip their kids as best they can and keep as much money in the family.
Hi, and welcome to Between Meetings with Matt Heiner. In this podcast series, NetWealth CEO and Managing Director chats to industry leaders and innovators with local and global expertise. They discuss the latest technologies, business models, and demographic changes, as well as leadership lessons and trends that are impacting financial services. We hope you enjoy their unique insights.
Hi, and welcome to this episode of Between Meetings. We're lucky to have our second guest all the way from the UK joining us today. Welcome to the show, Vicky Hicks.
Morning, Matt. Thank you for having me.
Absolute pleasure. Our team recently came over to see you and we had fantastic feedback around some of the work that you were doing. You're the CEO of Melo Capital, and we'd just love to hear a bit about your journey and also about Melo.
I've always worked in financial services. I became a financial planner when I was 23. So I was one of the youngest financial planners for a very large network in the UK called Openwork. Progressed through my career to being one of the owners of a directly authorised chartered financial planning firm. So we dealt sort of directly with the FCA. Grew that business. We were part of a group of firms. We sold at the end of 2018. It was a disaster, Matt, an absolute disaster. So much so that I actually had to leave my career as a financial planner because I was under a purchase agreement with the buyer. It was a case of like, you work for us for this period of time. You don't compete against us. All the stuff you would expect. But I could not cope in that environment. And it was incredibly challenging. Being a financial advisor was kind of a big part of who I am. And I assume it's the same, for you guys over there. Like, we take it very seriously. And it just made me reflect and go, what on earth went wrong? Like, how did our sale go so wrong? And why am I reading in the press that so many people are disappointed after they've sold? So it took me into mergers and acquisitions, and I launched our M&A business in April 2019. And I wanted to bring real world experience to helping people to sell. I wanted to give them open access to all of the buyers that were out there. And I wanted to hold their hand from sort of start to finish. And I've been doing it now 7 years, been involved in over 100 sales, large down to very small. And yeah, I suppose I kind of know a thing or two about the acquisition space. And I'm a bit like, have you ever heard of Mystic Meg? I don't know if you have Mystic Meg over where you are. She was a lady that used to do horoscopes in the UK. I'm like your Mystic Meg, so I can tell your guys what's to come in kind of the world of M&A, because I think it's hotting up where you are right now.
What a great story. Very relevant with what's going on in Australia at the moment. We're seeing a huge amount of international capital coming into the country. We're seeing some really big aggregation groups emerging. And I guess your experience is incredibly relevant. And we've got a lot of firms that are either looking for growth capital or in many cases also looking at retiring and selling their business either into an aggregator, into another firm. So your experience is incredibly relevant. And the other feedback that we've had, and picking up on a discussion we had on a previous podcast, is just the change in the industry in the UK, how much it actually looks like our industry maybe in 5 years. But also, I guess that the trend that amazed me, I think the statistic at the time was that there's around 85% of the UK is now owned by private equity or through aggregators. Is that right?
Yeah, I can believe that. Like, it's a tale of two halves when you look at the sizes of business in the UK. So this might relate to you. You've got your very large firms, and the FCA kind of group those as having 50 advisors or more. And as you said, they probably now own around 85% of the advisors that are delivering the advice. But the majority of firms, if you were to just look by number of businesses, are actually very wee in the UK. You know, sub 5 advisor firms absolutely still dominate. And there's a space for everybody. Private equity, good, bad, indifferent, kind of whatever you feel about it. It's helped to create an exit route for a lot of people. It's just when it all kicked off around sort of 2018, 2019 in the UK, so many private equity firms came in at the same time that there was so much demand that prices kind of rallied, but also the wrong matches were made. And if I was to sort of go back in time or to get a message across to a country that's going to go through this, it's payers protect the independent and the privately owned businesses, right? There is a space in the market for the private equity-backed consolidators. They've got the money, they've got the investment, they've got the ability to deal with the advice gap, which is a big issue, I know, in Australia as well as it is in the UK. But if you're running a small business offering face-to-face advice, it's really personal, maybe they're not the right outcome for you. Maybe they are, but actually maybe opportunity within local to local buys or privately owned sales to privately owned buyers, like they have a space as well. And in my view, too much of our market initially got swept up in the frenzy of the private equity coming in and making big offers.
And was that also coming in from the US, or was it also local PE money?
Yeah. No, coming in from the US. And actually what we're seeing now is more US private equity interest, because we've come to the end of our first cycle, or we're coming to the end of our first cycle. So private equity maybe has a 5 to 7 year, ideally, investment horizon. And over that time, they want to do a 3 to 4 times growth. So it's an aggressive growth strategy, but they've got to create liquidity to get their shareholders out. Because the majority of private equity money came in 2018, 2019, 2020, a load of them now are getting to the point where they've outgrown their current PE investor, or the PE investor needs to get liquidity, as I said, for the shareholders. And they're of a size where actually they're interesting to the larger PE houses. And so the US now are seeing this sort of, the buy and builds have done it for the last 5 years. They've made it work. They've created something of size. Actually, this is still a great investment for us. And we can see still where we can take this business to over the next 5 to 7 year cycle.
So a lot of the stories over here, it's about sort of, I guess, patient capital, but also growth capital, and also roll-ups where they'll then look to potentially IPO or list either locally or overseas. Are you able to just maybe focus a little bit on the types of transactions that you're seeing and maybe some of those sort of roll-ups and the build to buys?
The majority of firms that came in are what I would call buy and build consolidators. So essentially, they'd seen an opportunity. They had a pocket full of cash. They had a strong board, but they had a need to very quickly deploy that capital and buy something and get a foothold in the market. And so the way that some of them kind of set up and launched was they wanted to acquire businesses that had leadership teams in them. And of course, if you fully buy out your shareholders, but the leadership team don't have any skin in the game, what have you really bought? How successful is it going to be after the sale? And are you going to have an issue where actually the leaders or the key people in a business end up kind of walking away? So we saw deals where there was essentially a retention of equity. So that as part of something bigger, the people that were left behind were able to grow their retained equity piece. That was quite attractive. That was kind of a way to align motivations between the buyer and the seller. What we've seen more so as kind of the market has matured is a movement away from retained equity in your own business. And now we will have private equity firms that will say, well, look, we'll buy your business, let's say for £10 million, right? I'll use sterling. Buy your business for £10 million, but we're going to pay you 8 in cash. And then 2 million, we're going to roll that into equity in our top co. So you're not responsible from an equity perspective in terms of what just happens in your bit. Actually, you're buying into the overall business plan of what we're looking to achieve. Either a full buyout or a small minority equity retention or a small role is the kind of what happens in the majority of cases. But what we're seeing now, which interests me, is we're seeing more of an emergence of investors that are going, actually, we really like your business. We don't want to roll your business into what we're doing. We want to take a minority stake in your business. We want to power you with access to money so you can go on to grow. We want to give you access to our board of people so you've got the support to scale. And then in the future, of course, there's maybe an option agreement or something like that, right? Where we can buy the rest of it. And that model's really popular in the US. It's been slow to come to the UK. If you guys actually kind of kick off acquisitions, having all of these different routes available, then that's where your business owners, I think, have a real exciting opportunity to not just take the first thing that kind of comes their way or the first person that knocks on their door, but to go, well, what's really going to work for us? What's really going to work for our business moving forwards? Because there's options out there to kind of do everything if you start with what's important to you. So we are seeing now more of an interest where investors are going, we like what you're doing. We like your business. We like your brand. We believe that you have the infrastructure and the ambition to grow. Let's take a minority equity stake in your business. It gives the owners then a little bit of a golden hurrah, right? A little bit of a capital event. It gives them access to a funding line so they can go on and grow. But it also gives them access to a bigger board of people who've kind of built businesses before and can help them out. So I think we're going to see more of that now in the UK. And that's a very popular model in the US. Is going to become more popular in the UK. But for you guys just kind of starting out in acquisitions and being a few years behind us, if your acquisition, if it all starts with all of these options being available to your firms, then they can make really good choices. When M&A started to kick off for us, 2018, 2019, there wasn't all these sorts of flavors of types of options available. If there was, I think we would have made some better matches. So, your guys start with your objective, start with what will work for you in your business, and then go out there and kind of find who will power that to happen, because there are so many options out there for people.
Going back to the beginning, what was it that attracted a lot of these sort of international firms into the UK initially? And what does a typical practice look like, and some of the key metrics that you look at?
So the age of the average advisor was a big attraction. The recognition that in the UK we had loads of tiny businesses and therefore they didn't have the leadership teams in place that were going to be able to do the succession internally to do like a management buyout, right? So private equity went, well, this is great because we can see that there's a load of people that are going to want to retire. And because these are small businesses that are all fragmented, actually, we can benefit from efficiencies and synergies by bringing them together and reducing the overall cost base. I don't think it quite worked out like that for a lot of them, because I think a lot of them forgot that actually, as you grow something bigger, you have to start to bring in levels of like leadership and management that perhaps aren't there in the smaller businesses. So some of them didn't get their the profit and loss accounts quite right, I think, in that regard. What else people are looking for? It's the strength of the recurring income. That's what's really interesting to private equity firms. It's that persistency of data, of income. Essentially, we're like a subscription model, but a subscription model where your client retention is, 95%. So there's a huge amount of value in that. And also, what a lot of the private equity firms are looking at is they're saying, well, clients pay a fee stack. They'll pay this amount to their advisor, this amount to their platform, this amount to their investment management. At the moment, these advisors are just charging for their advice or they're charging for their planning. But actually, we can launch our own investment manager, for example. So we've got the scope to not just benefit from the profit and the revenue that the firms are generating at the moment, but actually we can, essentially penetrate our investment solution and therefore generate more fees. So it's a perfect storm of kind of fragmentation, aging advisors, strong client relationships, and the scope to uplift fees.
Interesting point you raised there is on what we call, and I presume you call over there, vertical integration, which is really how for the UK RDR started and how we ended up with a Royal Commission. How are firms now dealing with that? Because in many ways it feels like Back to the Future.
The FCA are all over this, Matt. So we had something a couple of years ago called consumer duty. I think you call it something different over in Australia. I'm not sure what you guys call it, but we had the consumer duty, and essentially it's really given the FCA teeth. And what the FCA are saying is, it is not just, consumer duty is not just about how you run your business, right? And ensuring fair value and all that good stuff that's come out of it. It's also about when you make big decisions, such as selling your firm, are you doing that through a consumer duty lens? Are you ensuring that whoever's going to take on your clients, that those clients are going to continue to receive the value that they have been? And so naturally, as a result of that, the FCA have had a real keen eye on the firms that have their own in-house investment solution, kind of to see, well, look, are clients being moved into that in-house investment solution because it's in their best interests, or because you as a business are gonna benefit from that? And they did something called the consolidation review around a year ago, and they continue actually to look very closely at, have people been incentivized to move assets? Is this part of the deal that's been agreed? Now, we sold to a vertically integrated private equity firm, and I came into M&A going, I hate private equity. I hate vertical integration. And what being in M&A has taught me is there are 50 shades of private equity. There are 50 shades of vertical integration. And if a firm has their own investment solution, and that is, more cost effective than what you have at the moment, it's just going to offer better outcomes for clients, then that vertical integration can work, right? But if you're running your client assets on, using passive portfolios, or you've been banging the drum that, you keep the cost of investing down, and you then go and sell to a firm whose in-house solution is an active portfolio, right? Then there's a clear mismatch and a clear issue there. So it's important to look at and be aware of. A lot of sellers still come to us with very strong views based on what they've read. So they'll come to us and go, I don't want a vertically integrated firm. I don't want to sell to a private equity-backed consolidator. And it's because of what they've read. And we're like, look, you've got to make the decisions that are right for you, not based on what you've heard. So when we take a firm out to market, we'll give them a whole range of buyers, so that if they don't think they like that type of buyer, at least have the chat, make that decision yourself, because I've been amazed at how often I've made those introductions and people have gone, actually, this works really well for my business. So not all vertical integration is bad. Equally, it's definitely not all good.
Imagine a world where wealth technology is simplified. NetWealth is continually investing in new tools and platform features to optimize your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo.
I love the coaching that you provide to the firms as they go into the sale. Are you typically working for the seller, or are you also working for the buyer on some transactions?
No, we work for the seller. So at Melo, we're a sell-side organization. It was one of the reasons actually, when I was looking and going, why have all these sales gone wrong? I actually tracked one of the reasons back to the broker community. And so a lot of the broker community in the UK had maybe been born from recruitment firms and stuff like that, where they'd been putting candidates into businesses, and then all of a sudden they started to notice, actually, there's something going on here. Oh, let's set up some terms and let's try to help these businesses to buy firms. And if you use a broker, that's being paid by the buyer. Well, first of all, under the law of agency, they're working for the buyer, right? And secondly, they're only going to introduce you to the buyers that they've agreed terms of business with, that are going to ultimately pay them. So when I launched, I was like, I don't want to do buy side. For me, sell side. I'm not taking any commission then from any buyers. I'm actually buyer agnostic, and I can just take the time to help them to find the right outcome, project manager, and do a proper job. So that's my view. And I think, I don't know if you have many brokers yet in Australia, if it's kind of maybe just starting to hot up, but that would be one of my messages to your guys, would be, when you go through a sale, you've got to build an exit team around you. It's an incredibly hard journey to go on. You've got to keep running your business, doing your reviews, generating those fees. So you need people around you. Please make sure anybody you've got on your team, you're paying them. Because if someone else is paying them, they ain't on your team.
What are some of the other bits of advice that you give to sellers that come to you? Have you presumably you've got a process that you go through? Where does that start, and what are the typical pitfalls other than working directly with buyers or not paying their team?
So one of the biggest mistakes that people make is that they do the process the wrong way around. So a buyer will get in touch with them, or a broker will, and they'll go, yeah, we'll have a chat. And then they'll go and have a chat to them about selling their business. And then the buyer will go, I enjoyed that chat. And they'll go, I enjoyed that chat. And the buyer will go, right, provide me with all of this information. And the seller goes, I don't have all of that information. And things come to a grinding halt. So actually, what you're better off doing is approaching the exit process the other way around, right? Wherever you are in your journey, you're going to exit at some point, right? Hopefully, if you don't want to exit for 10, 15 years, you'll manage to stay around for that term. But sometimes people get ill, or there are serious issues that mean people have to sell before they expect. So being ready to sell doesn't mean you have to sell, but it gives you optionality. And any smart business owner should be creating optionality. So take a look at your business, assess where it is from a value perspective, assess its cleanliness and its ability to get through the due diligence process with a buyer, and then move into, actually, well, what are our objectives? What types of buyers are out there? And then we start to have meetings with the buyers. So we have a 3-stage process. Stage 3 is where we actually go out to market and start meeting buyers. Stage 1 and stage 2 are all about prepping, getting ready, building the data, making sure it's clean. And as I said, often it's done the wrong way around. So don't rush into meetings with people. If somebody piques your interest because they send you an email and they go, oh, we've got a buyer in your area, or we're offering great rates, sit on that, pause and go, okay, if this has piqued my interest, let me just look under the bonnet of my business and make sure I've got my ducks in a row. Do you say ducks in a row in Australia? Yeah. Good.
I'm a pom from way back, so I understand what you're saying totally.
Okay. As long as you do, everyone else will be like, what? How many ducks in my business? What's she on about?
Given that you've also got so many potential groups at those different stages, how many get to that first stage and actually realise they don't want to sell at all, but they want to enter into a succession arrangement with other financial planners in their business or other staff?
We split it out into what we call internal exits and external exits. So an internal exit is, I'm going to sell to my team, or I'm going to sell to my management. An external exit is of course, I'm going to do a trade sale. And if a firm has the ability to do an internal exit, and when that works, it works really well, because you've got the leadership team, you trust them, your legacy remains, the business that you've grown gets to transfer hands. Like, it's a very, very beautiful story, but it's hard to do. It's actually harder to do an internal exit than to sell on the open market, because when you're doing an internal exit, you've got to hire the right people. You've got to train them. You've got to retain them. You've actually got to start letting go of the reins as the business owner. Whilst you're still in there, you've got to test them and make sure that they're going to be capable of continuing to run it. So when we start that kind of initial exploratory stage with our firms, and we're looking under the bonnet of the business and we're understanding what they're all about, we'll check out with them all the routes that are available to them. And we'll discuss the pros and the cons. And if an internal exit is the route, then we'll take them down that route. And if they've got to sell, then we'll take them down that route. But getting the team's involvement, or your key people, getting their involvement in either scenario is really important, because in the UK, probably will be the same for you guys. The way that deals are structured is there's a big earnout. So you might get half of your money, 60% of your money on completion of the deal, but then the rest of the money is going to come to you maybe over 2 years, over 3 years. And that's going to be possibly conditional. It certainly is in the UK in the majority of deals, subject to rises and falls, essentially, if clients don't stay. So you may think as the owner, I've just got this brilliant deal. Isn't that great? Look at how much I'm going to receive. The true success is if your stakeholders, your staff and your clients are happy after you've signed on that dotted line. And that's why you can't just spring that on them, right? If you've got key people in your business and you just call them up one day and go, hey, guess what? We're selling to ABC Financial next week. They're going to be like, I didn't choose to work for ABC Financial. I feel like I've not been involved in your thought process. And, oh, actually, is this now my time to go on my own? And one of the biggest issues for consolidators in the UK is what we call the breakaway advisor. It's the people that actually have the client relationships, and post-purchase, we're kind of now seeing like a whole wave of new firms set up, which are from the breakaway advisors that haven't benefited through the sale. And so they're going and they're doing it themselves.
We're definitely at that point of the cycle now where we're seeing, having had a lot of the aggregation, we're now seeing de-aggregation and new groups forming all the time. And one of the ways that firms have tried to solve that is through issuing equity to others in the firm. What are the good models that you've seen that works? Is it shadow equity? Is it actual equity? Is it based on loans that the principal makes, or all of the above?
All of the above. And it very much starts with, what are you trying to achieve through retained equity? Is it just to try to retain somebody? Is it to try to incentivize them? Is it because you want them at the boardroom table, kind of determining the direction of the business? And then from there, you can put in some form of equity participation scheme that works for you. So that could be giving equity. Now, there can be an income tax liability if equity is given. So again, there's often ways to deal with that. For example, the firm might pay a bonus or be meant to pay a bonus that's going to cover the tax, and then that goes towards that. So there's that route. But then we have things like LTIP schemes. We have EMI schemes. They're quite popular. So through an EMI scheme, essentially what you're doing there is you're giving your key members of staff the option to acquire shares, but at today's price at a later date. So in those scenarios, you've not given any equity away. So if actually that person or anybody that's in the EMI scheme ends up leaving, then that's fine, right? There's not some big thing that you've got to do with public filings or anything like that. But it is certainly a way to still incentivize them and for them to know that if this goes well, I'm going to earn some decent value out of it. So in the UK, we get HMRC clearance on that, put the EMI scheme in place. It means that you're not giving away equity on day one. So if somebody leaves, there's not some big issue in kind of having to do all the paper refilings, get the shares back or anything like that. But the option to acquire the shares later on can still be hugely attractive to key members of staff. So a scenario like that, you can tick all of your objectives. You can go, well, I can still incentivize through helping them to create value, but I'm not, tying myself into giving somebody equity today. So we always just start with, look, it's not as simple as let's just give somebody some equity. There are many ways to sort of skin that cat. So let's really understand, well, what's your motivation behind wanting to give them equity? And sometimes your motivations for different members of the team are also different. So in an EMI scheme, you can set different terms for different people, right? Based on them hitting certain hurdles or doing certain things. So never rush into making a structural change, because there can be all sorts of implications. Implications on day one from a tax perspective, implications when you come to sell, because if you've not got that part right, the buyer might go, well, hang on, you gave little Freddie or you gave Sally this option or these shares, but actually we don't agree with the valuation that you did back then, right? And then it can come and bite you in the bum. You don't want to go and make a decision today that impacts you later on, right? So anything like that at all, or just take advice is what I'd say.
Vicky, I'm conscious that we're getting close to time. What excites you most about the next 5 years in the UK market? What are you seeing on the horizon that sees the industry solve for the advice gap and some of the challenges that we're all facing?
AI. Everyone's probably so bored of AI now and talking about it, but unfortunately, it's just woven into the fabric of our lives. We are not using it effectively at all at the moment in the UK. We're essentially, was it the board who did the Model T cars? At the moment, we're making horses faster, right? And people are using AI for things like note transcribing, or maybe even taking those notes and populating a fact find or populating a suitability report. And that's great, right? That's going to create more capacity. It's going to allow advisors to be able to service more clients or maybe enjoy more time on the golf course, kind of whatever floats their boat. But what it's really capable of is somebody somewhere is going to come out with something that is going to just completely change the landscape of what we do. And I don't think financial planners need to feel threatened. I just think they need to keep finding the human. Because in the UK, we're dealing with 9% of adults, right? Let these new solutions come out. People deserve financial advice. People deserve financial planning, right? So let these models take the market and be able to offer the appropriate solutions. But don't become blasé, right? And think then that those models aren't going to come and start sort of, grabbing at the heels of your clients. What's going to happen, in my view, is through AI, through new solutions, essentially make advice like available in your pocket. If you see the ChatGPT finance module in the US, for example, like this is financial planning in your pocket. I think it's going to make consumers more aware of what they're paying. And whilst we're totally transparent with fees, we've had to be since RDR, even more so since something called MiFID a few years ago, clients don't really have a basis for comparison on fees. And I think when it becomes more commonplace to have your advisor in your pocket, clients are going to start to go, well, hang on a second, why am I paying all that money over there when I'm getting that through an app? So it's going to be the biggest shift. It's going to help with the advice gap. It has the potential to decimate some business valuations if all the businesses are doing is what AI is going to be capable of doing at a fraction of the price. But actually, if you get your head out of the sand, like don't think this isn't going to impact you, and continue to focus on the experience that you're delivering to clients, the overage value that you can create as a human being in excess of tech, then you'll thrive. So that for me is what excites me. It's what AI is capable of bringing by way of new models and new service delivery, but it absolutely is going to impact on the existing firms that do not continue to work on what they're delivering and create additional value. What do you think, Matt?
We're seeing exactly the same thing over here.
Yeah.
And I think that the reality is that advisors play a much more important role than just the algorithmic advice that a LLM can add. So it is about a relationship, and it's about people staying on course and knowing that there's someone looking out for them. So we're very bullish on advice over here, and think AI is an enabler to deliver more advice to more Australians.
Yeah, we've got with the breakaways and stuff that we spoke about earlier on, the breakaway advisors. You've got your business owners who are maybe coming towards the end of their career, they're coming to state retirement age. If you've only got a year, 2 years to go, you don't want to append your model. You don't want to go through the hassle of kind of creating a new operating model with AI. Those firms, it's time for them to transition out. But this new wave of advisor, business owner, they're in their 30s, they're in their 40s, they've grown up with tech, they love financial planning and financial well-being. Like, I'm so excited about the firms that I'm seeing being built.
And Vicky, where are those firms coming from? Because I think maybe not dissimilar to the UK, we've talked about the advice gap, but with a limited number of advisors, 10,000 advisors, which is not growing, it's not clear where that next inflow of advisors is actually going to come from, particularly given many of the banks and sort of large institutions exited in 2017.
Well, they're coming back in the UK. The banks are back. So I don't know whether that's going to be, a thing for you, but, they are back and they're looking at targeted support. And the FCA are talking now about bringing in a new qualification level, right, which is lower than our level 4, but then maybe will work to kind of as a stepping stone for people becoming a full financial planner. And then they can start to deal with the mass market that maybe just have more simplistic needs. So that will help. Some of the firms are running academies, but here's my soapbox moment. The educational route for advisors to come in needs overhauling, right? They are doing the same exams to get in as I was doing 20 years ago, right? And we're in a different world now. When AI and tech is going to be capable or is capable of taking more of the technical burden, and actually what we're talking about is the power of the human, right? Why are we not training people up in how to talk to people? Like, these are just little periphery kind of side courses that people are doing. And this should be an absolute core part of the syllabus in becoming an advisor, right? Like psychological awareness of how you deal with money. How do you deal with people who are going through catastrophic things, right? Deaths in the family, poor elderly parents, whatever it might be. So I think we need to kind of overhaul that. And my view is, in overhauling what exams you need to become an advisor, you actually then start to attract a different type of talent in, because they're not looking at 6 exams that are like tax, pensions, investments and thinking, well, I don't relate to that. They're like the psychology of money, how to coach people through really challenging times. So there's like all of these bits that we need to fix. And if we don't look at things in isolation and we kind of look at the whole, then I think we fix a load of these problems. But unfortunately, I'm only one lady, Matt.
Vicky, you've been incredibly generous with your time. Last question from me. Are we going to see you in Australia anytime soon?
I would love that. I've never been to Australia before, but one of my colleagues is from Australia. He's a Victoria boy. So as soon as he knew I was talking to you, he was like, Melo Australia, put his hand up. He was like, I'm up for it.
Oh, we'd love to see you over here. And thanks so much for sharing all of your advice. It's amazing just how similar the two markets are, but you're definitely a few years ahead of us.
Yeah. And if you want me to come back and dive into anything else, just let me know.
Fantastic. Thanks, Vicky.
Thank you.
Thanks for listening to this episode of Between Meetings. For more episodes and to subscribe to our series, visit the NetWealth website, iTunes, Spotify, or your favourite listening service. And if you want to contact me or engage or discuss any of the topics raised, please find me on LinkedIn or Twitter or send me a private message. We hope you can tune into the next episode.